All right. Well, I believe that it is time to start the event. So, hello, everyone. My name's Scott Orvold, and I am the Accounting Student Association president. And I thank you all for attending the 2022 Contemporary Accounting Forum. This event is a webinar brought to you by the Accounting Student Association at the Milgard School of Business, University of Washington, Tacoma. This webinar brings together industry professionals to discuss blockchain and cryptocurrency topics so that we may educate ourselves in this ever-expanding area of knowledge. The webinar will have 4 panelists and a moderator. First, each panelist will be introduced by the moderator and given the opportunity to share their professional insight about their area of expertise. This part of the event will be for approximately 40 minutes, and at the end of that time, we will take a 10-minute break. Once we come back, the panelists will engage in a 40-minute roundtable discussion about various topics and questions that we believe will give all attendees a better understanding of the blockchain and cryptocurrency landscape. After, we will hold a Q&A session for the remaining time of the event, where you, the audience, will have an opportunity to type your question into the chat, and we'll share them with the panelists for feedback. The moderator for this event is Sundeep Verma. Sundeep has more than 40 years of international auditing and accounting experience, including 20 years at Deloitte. Before retiring from Deloitte, he served as the global risk advisory leader in mining and metals sector with the Fortune 200 companies. At Deloitte, his responsibilities included providing oversight to global outsourced internal audit functions, communications with senior management and board of directors audit committees, coordination with external audit leadership, and providing overall direction and advice to the global project teams. He specialized in business controls, process reengineering, financial, operational, and compliance audits, forensic investigations, anti-fraud programs and controls, fraud risk assessments, Sarbanes-Oxley Acts compliance, and internal audit risk assessments and internal audit management. While at Deloitte, Sundeep also provided specialized internal audit service to clients in a variety of industries, including manufacturing, financial services, telecommunications, and real estate. Prior to joining Deloitte, he acquired a broad and diverse background in commercial finance as a principal with the regional public accounting firm, specializing in providing due diligence and fraud investigation services to major banks and financial institutions serving clients in various industries. Mr. Verma holds a Bachelor of Laws from the University of Delhi Law School. He is also a certified public accountant, certified internal auditor, and a certified fraud examiner. Currently, Sundeep is an executive in residence at the Milgard School of Business here at the University of Washington, Tacoma. We are very excited to have him in this role and benefit greatly from his experience. So without further delay, I would like to turn over the event to your moderator, Mr. Verma.
Thanks, Scott, for the introduction. Good afternoon, everyone. I would like to welcome you to today's webinar on blockchain and cryptocurrency. I believe there's hardly anyone out there who has not heard about cryptocurrencies. This is really a hot topic and is being discussed in online forums, newspapers, business magazines, with your brother-in-law during family dinners. And I was actually very surprised to see that it was even in commercials during recent Super Bowl. Some people are calling it the next internet, and others feel, well, it's just another fintech fad, and it will go away in a few years, so don't worry about it. We often hear terms like wallets, exchanges, tokens, NFTs, and other jargons, and have difficulty really comprehending the meaning of all these terms. There are so many questions in our minds related to cryptocurrency and blockchain. Well, we'll try to find answers to at least some of these questions on this webinar. So let me introduce to you our first panelist, Samar Raza from BDO. Samar has more than 8 years of public accounting experience serving public and privately held companies in a variety of industries, including oil and gas, real estate, technology, financial institutions, and manufacturing. As a professional practice senior manager, Samar works with the methodology team to develop practical solutions to assist engagement teams in effectively applying the relevant auditing standards, both domestically and globally. That includes developing and implementing firms' audit guidance and tools on audit engagements. In this role, she also provides consultations to teams on specific technical guidance in relation to risk assessment and inventory. Summer also leads the firm's development of guidance, including tools and techniques on how to audit digital assets. In this role, she also actively contributes as a thought leader on the firm's digital asset subject matter group. So Summer, could you please share your thoughts about auditing various areas like valuation, recording, disclosures for digital assets, and any other key areas you're discussing with your clients?
Yes. Good afternoon, everyone. And thank you, Cindy, for such a great introduction. I would like to also thank Gary and the ASA board for having me on the panel today. Like Sundeep said, I mostly handle the accounting and the auditing side of cryptocurrency. So I would like to share some consideration and insights on what exactly that looks like and what that means for us. But before we touch on that, I do want to touch on what exactly a cryptocurrency is for those that might be new and would be wondering what exactly that means. So a cryptocurrency is basically a medium of exchange that's digital, encrypted, and decentralized. So unlike a dollar or a euro, there is no central authority that is managing or maintaining the value of that cryptocurrency. So instead, these tasks are broadly distributed among cryptocurrency users through the internet. So I will refer to cryptocurrencies as digital assets throughout my presentation interchangeably, but they pretty much mean the same thing. To understand how digital asset ecosystem affects the auditing side of things, I thought it might be useful to refresh on how exactly auditing works too. And for those of you that haven't decided that auditing is the right career for you, this is my elevator pitch. Consider that. So basically, in the auditing world, management prepares financial statements, right? Which we audit, and as auditors, we provide an opinion regarding whether the statements have been fairly presented and in accordance with the applicable accounting framework, which is US GAAP or IFRS. This opinion that we provide greatly enhances the credibility of those financial statements for the users, which could be lenders, creditors, investors. Now, how well our opinion is, the more users are likely to invest, provide credit funding to a business, and possibly result in like a reduced cost of capital. So auditing is all about obtaining sufficient and appropriate audit evidence to support that opinion that we're providing for that client. And that is no different for an audit that involves digital assets too. What changes though is that the type of evidence to be obtained for digital assets are a little bit more challenging because the more risk there is involved in an audit, the more audit evidence you actually need. In real life, if a client is investing in a digital asset, let's say Bitcoin, because that's a very, very well-known cryptocurrency, in order for us to provide an opinion on the financial statements, we need to look at management's Bitcoin investment and ask, one, is it reflected accurately? Two, we need to verify that management actually owns that Bitcoin in the digital world. Three, we need to assess, is it valued properly? For example, let's say today it's worth 60,000, and then on the reporting date, it's worth 40,000. So what's the market price that we're reporting the Bitcoin at? And then four, just making sure that all the disclosures relating to the Bitcoin investments are properly reflected. To address this, we will most likely obtain evidence from the Bitcoin blockchain. But in some circumstances, we also have to pause and ask at auditors, can I really rely on the blockchain? If we obtain evidence from the blockchain, can I use that evidence? How do I get comfortable that that blockchain is really telling the truth and that if we're relying on it, it's appropriate? Those are the types of questions that now we have to ask us as we're auditing any client that's related to digital assets. So largely due to the complexity of the underlying blockchain technology, there are definitely unique risks and related audit challenges involved. The AICPA has stressed very importance for auditors to go through a number of considerations before taking on a client with digital assets. In particular, before accepting a client in this realm, it's the auditing firm's responsibility to review 4 things: the auditor skill set, the management skill set, management's integrity in this area, and then the processes and the controls that are involved. So I'll quickly touch on this to just show you what are some of the things that we consider. When we talk about the auditing skill set, auditing in the digital asset and the blockchain ecosystem is different now. It presents some unique challenges, unique need of evidence gathering, a need for different auditing tools, analytics, automation, and also changes in our talent perspective. So now the audit firm may choose to employ specialists in cryptography, blockchain technology, data analytics, and valuation. It's very important before accepting a client or even deciding to retain the client that the auditors think that they have the appropriate skill set to serve that client. The second thing that we look at is management skill set. It's important to consider if management has the skill to support the financial records that they're presenting in the very technical space. There's also an emphasis on the importance of management understanding the evolving regulatory environment and being in compliance with it, understanding if management has the appropriate and correct specialists or consultants that they need to apply the financial reporting framework appropriately. The next thing is considering the overall business strategy. This is very important because this field and this space is evolving so quickly. We see new forms of digital assets, new use cases for blockchain technology. It's important to understand the why behind what the company is doing, to evaluate if this is a company that can be audited and if it's appropriate business reason for the engagement that they're doing. And then the very last thing that's very important are controls. Controls are so important in this space. We see very unique controls specific to digital assets, such as those related to the safeguarding of digital assets, transaction monitoring, reporting, and controls relating to the third parties that are holding the management's digital assets. Controls are definitely an essential part of this space. So we see the digital assets ecosystem that things are rapidly evolving as the time progresses, and it is continuing to progress. We see many more types of digital assets entering the industry and the world. It's so critical for auditors to pause and understand the entity's specific role in the ecosystem. What are the assets that they're engaged in? Why? And all of this to be able to perform an appropriate audit. This is definitely not a space where we have exact procedures that we perform. And there is no template on a one-size-fit-all approach where we take certain procedures and we go and apply it to a company. Every engagement is different, and every engagement brings different types of risks associated with it. And there are so many different types of digital assets that the company is engaging in, and we have to make sure that we are in line with those skills to be able to address those. So, I mean, ultimately, as I close, I would say that as an auditor, like, our responsibility for gathering evidence relevant to management assertion regarding the fair presentation of the financial statements remains the same as it would be for like a manufacturing company. However, the nature of the procedures performed and the evidence that we need to support our opinion has greatly changed because of this new ecosystem that we have entered. We are required to apply our expertise and work with all stakeholders to develop a comprehensive approach to accepting, designing, and executing the audit of digital assets. But it's definitely an ever-evolving world that we continue to learn from, and we continue to grow and understand.
Thanks, Summer. Just a quick follow-up question for you, since you're probably dealing with global clients too. So we have GAAP and GAS here, we have good guidance here. What about the countries where they are still not very clear, or they have not come up with guidelines? So how do you reconcile the auditing procedures performed there and what you're performing here so that you can issue an opinion on the financial statements?
I think that's a great question. I think right now what we're seeing in the regulations and in our auditing standard is that there are very, very little guidance on both fronts, whether it's IFRS or US GAAP. But what we have seen is that the guidance that has been provided thus far is consistent. So where there aren't any rules in the IFRS, there are rules for the US GAAP side. So we're adhering to that at the moment, but we are hoping as the time progresses, there are task forces that are now being set up. I know there is one under AICPA, and IAASB is also planning and looking at it. And the more and more we go in detail and the more time passes, I'm hoping that the task force are going to provide a uniform accounting and auditing guidance for the teams to use so that we can make sure that the reporting that we're providing on both the US front or globally is consistent and it is providing all the information we need for all the relatable stakeholders.
Yeah, and not getting into technicals of valuation, but with all the volatility going on, do you see a lot of impairments going on, and how do you deal with that?
Yeah, I mean, definitely. So according to the US GAAP, if you have an investment, if a company has an investment in, let's say, Ethereum day one, and they are supposed to subsequently review that investment to see if an impairment has occurred and it has been triggered. So if that investment price decreases every quarter or every month, it is the company's responsibility to make sure that assessment of impairment has been triggered. And if it has, then that impairment loss is reported. And that's something that is the management's responsibility to perform. And because the market is fluctuating and there's some days where it's doing really well and some days it's not doing so well, it's very important to kind of understand the metrics of the market when you're handling this to make sure that appropriately and accurately being reflected. And if impairment has been triggered, it's properly being recorded and reflected as well. And there's a huge assessment that goes into impairment analysis as well. There's so many different assumptions that go into play. You have to make sure that all of those assumptions, everything that is coming and being used as an input is appropriate and accurate.
Well, thanks, Summer. Really appreciate your insights on this topic. Our next panelist is Paul Pack. Paul is a senior manager in the risk advisory practice for Deloitte and has been with the company for 11 years. He recently returned from Tokyo, Japan, serving a large multinational bank. Since moving to Seattle, Paul has focused on digital assets clients, including one of the world's largest cryptocurrency exchanges, a multinational payment processor, and a local global cryptocurrency exchange. He oversees teams in both general information technology controls and business process controls. Paul received his Bachelor of Science in Managerial Finance and his Master's in Business Administration from the University of Mississippi. Paul is currently a certified information systems security professional and is a member of Ascent. So Paul, when you're meeting with your clients, what are the key topics you're discussing with them from a risk perspective? How are you helping them mitigate those risks? Could you share your insights with us on that?
Absolutely. And Sundeep, thank you for the intro and thank you for all the students for joining the session. One of the things that we see on a day-to-day basis with crypto clients is there's some type of risk, some type of problem that they're trying to get through. So one of my clients is a payment processor, and some of the risks that they're facing is, they're using a third party as their exchange or their custodian. They're paying a fee to them, but then they're also, they bear the responsibility for the customer assets because it is their platform. And so the questions that I get often are, there's typically a problem. This is my risk. How do I respond to that? And what we do from a risk advisory practice is really just help them understand and think through what the pros and cons are for that particular issue. When it comes to blockchain and cryptocurrency, there's a variety of different factors that go into from a risk standpoint. You have regulatory risks, which as our landscape kind of continues to evolve and we get further specific regulations from the government, there are things that they have to consider from tax purposes, from accounting purposes. You know, as Summer mentioned, there's a variety of different things that go on in the auditing space. That's all kind of driven by regulation. So that's one aspect of the risk that we look at. Another is just kind of operational risks, right? So, you know, for that same example for the crypto payment processor, what is incentivizing my merchants to join my platform, right? Why even bother if I'm doing just fine, you know, paying with fiat, getting settlements in fiat? Why should I do this, right? And so, you know, as these companies go on this journey, more and more we're seeing those type of questions come across. So, you know, if I take a step back and give you a little bit more detail about that payment processor, if you think about your traditional payment methods now, so if I go to the local QFC and I decide that I want to buy a Snickers bar, I pay with my credit card, that gets, you know, processed and whatnot, and eventually settlement comes to the company after, you know, a day or so. With digital assets and with cryptocurrency payments, there's more, you get the funds quicker. So it's kind of, once it's recorded on chain, it's technically yours. You can use that however you want. So it's really taking them on a journey, helping the merchants go on a journey to really understand, you know, why market this product? What are the different risks that they're concerned with? You know, I'm sure everyone has seen news articles related to cyber incidents that occur where somebody's account gets taken over, they lose all of their assets. You know, there's some responsibility from the company to provide information, and you'll see blogs and whatnot of how to protect your credentials, how to look for phishing attempts and things of that nature. But then ultimately there's also things that could occur at the company that they're unaware of. So if I design a system, which most of the cryptocurrencies that crypto companies that I work with, they do a lot of their own development because they have the expertise. Their engineers are very well-versed in making sure that the system is designed properly. They don't want to really look for a third-party solution. There's flaws within the system as well that they're not aware of, right? So part of the procedures that we do is, you know, yes, an ATO, which is an account takeover, happened. What is the root cause of it, right? Understanding, is it just a customer problem, or was there also an internal problem as well? And what we're seeing is that, you know, with the speed that these folks are adopting and trying to integrate that into their current business, that, you know, things that you would traditionally see sometimes get missed, or we thought it was happening over here, but it's actually not, and we bypassed an entire control. Like to Summer's point, controls are super important within this space because everything is becoming more and more automated. So in that aspect, I mean, we deal with a variety of different risks that clients have, and it's up to us to really come up with the best solution or understand the root cause to provide the guidance for them to either implement, or if they need some help, you know, from our firm, we can provide that as well. So yeah, I think that's the biggest thing, is like those type of questions we get asked. And then if you kind of go down the line as well, if you think about, you know, I don't know how many times, you know, I've talked to my friends and I tell them, yeah, I'm working for a digital assets client. I'm working with crypto. And immediately they think of negative connotation. They're like, oh, those are all criminals. It's like where people go on the black market and like do all kinds of crazy stuff. You're funding like mobsters and all this. But that's not really the purpose of digital currencies, right? It's a decentralized, like Summer hit it right on the head. Decentralized meaning of you know, transferring funds to each other, things of that nature. You know, it's unfortunate that there are some criminals that take part, and you know, I think even, you know, some of the things that we've seen on the news, like when traditional means are cut off, they're moving to digital assets. But the big thing that companies are always doing, and if you ever opened up an exchange or a wallet account, you'll see that they do a very, very rigorous background check, which is part of their know your customer process, which is required by the government. Really understanding like why they're doing those procedures, not because they don't trust you, it's because there's just so many bad actors out there that they want to help prevent their systems and their business from serving those folks. And then, you know, another big thing is the anti-money laundering. Like you really want to make sure that the customers are doing what they're supposed to be doing and not trying to hide funds from the government. They're not trying to escape taxes or whatnot. So I mean, there's a variety of different things that we're getting asked questions on, but it's similar to what you would see at a traditional bank. Like those folks are have gone through those same procedures for years and years and years. And as we get more regulations within crypto, we kind of see that shifting to them as well, and making sure that one, your customer funds are protected, and two, you're not engaging in illegal or illicit activities, and three, you're just providing the best product for your client. So that's really in a nutshell what we do from a risk advisory space. I mean, we do audit support, for financial statement audits. That's similar to what Summer had mentioned. We do surveys and publish reports for emerging trends within the blockchain space. And then we also just kind of look at other applications of blockchain. And I'm sure we'll get to some of those questions as we go forward, but really exciting time for us to experiencing something new. Like I also did audits on a manufacturing client, and I have to say, after the first 2 times you do it, it kind of gets stale. But if you go into a digital assets client, everything is completely different. Everything is automated. They try to do things as efficiently, effectively, and as quickly as possible. And where those risks arise is kind of where we come in to really help provide value to the client.
Well, when we talk about risk, always people think about negative or the hurdles that we should be thinking about and how we're going to mitigate that. But risk is also opportunity.
Right.
So are you talking to companies who are not thinking about this blockchain technology and going and talking to them and saying, you should be thinking about and why?
Yeah, absolutely. I mean, a lot of the companies, especially the bigger ones, are starting to kind of put their foot in the water. They're trying to figure out, what can I do to capitalize on this? Because at the end of the day, any means that a company can use to make additional revenue, they're going to try to take, right? So going back to the crypto payment processor, they've actually hired us to perform a survey of what are the pain points of merchant adoption. So what are the biggest concerns that they have from accepting crypto? What are their biggest benefits, right? Of course, a lot of these merchants want to get a new customer base. And so a lot of the younger folks, and maybe some of the, I myself only dabble a little bit in crypto, but I'm sure that there's people in this room that have made quite a few dollars from investing in crypto. But it's, how do they capitalize on that? And then what does that mean for my business? Like from a licensing perspective, what do I need to have? Mm-hmm. So it's more going along the journey with them. If they have an idea, or even coming to them with a proposed solution or a proposed benefit that they could get, and then thinking through step by step, like, how do I implement this while meeting my regulatory requirements? How do I implement this? If I there's still PCI, like payment card industry standards, that they need to follow. Like, what are the things that I need to think about? Not just, I need to get this product out there and I want it out there now. You have to do it kind of in an organized manner. Otherwise, you'll fall into some of the pitfalls that we've seen from some of these clients.
Thanks, Paul. You're reminded of my days with Deloitte when I was in the risk advisory practice, so I can relate to all the things you're talking about here. Yeah. So thank you, Paul. So our next panelist is Jonathan Blanco. Jonathan is a longtime founder with deep experience in commerce technology and Web3 blockchain, who has built innovative teams, products, and companies, redefining how consumers interact with brands. Jonathan is the founder of TF Labs, a Web3 management consultancy and a startup studio, which recently spun out NiftMint, a commerce infrastructure for NFTs to be issued by brands. So Jonathan, most of the time when we hear the term NFTs, we relate it to like selling digital art online. And I'm sure the technology behind NFTs is being used in other areas. So how are you helping your clients in using this technology? And where do you see the future for this technology?
Yeah, no, first, thanks for having me. Really excited to be here with all of you. I hope you're all having a fantastic day. Look, when it all comes to how you move forward technology and how you move forward, problems at hand. So to get a little technical here for a second, is the token standard for fungible tokens was created, essentially really took off through Ethereum, right? So we have the ERC20 token, which is a fungible token. A fungible token basically means something that is kind of interchangeable. You don't really necessarily care if you have one token or the other. A dollar bill is something that's fungible. And from a non-fungible token, when the ERC 721 standard was created, it wasn't created to produce digital art. Like that wasn't the reason. It's like, oh, hey, I bet we could create a token standard for digital art. It was a token standard for non-fungibility, as in unique. And it just so happens that digital art happens to be something that's very unique, and that's what's been able to take off. So what you're seeing in the market today, and by the way, this, while it's been really popularized over the last, call it, year and a half, non-fungible tokens go back as far as 2016, 2017. CryptoKitties are probably the first iteration that was popularized of NFTs, but there were NFTs even before CryptoKitties. So I bring all that up and I talk about all that because while it is very interesting to have these digital avatars and PFP projects and digital arts for NFTs, and that's what's very popular. If any of you here are part of the Bored Ape Yacht Club, or have CryptoPunks or Doodles, or Crypto Toads, or all the different variations of NFT projects, I think that's great and I think that's fantastic. That being said, I think that's just one use case overall of what NFTs are. I always have fun saying that boring NFTs are going to take over the world. And so when I say that, what I'm saying is that, there's no reason not to have an NFT for different products or digital products for that matter. So what we're doing and what my company does is we create the commerce infrastructure for a brand or an organization to think about an NFT like digital inventory. So the same way they think about, hey, I need this many black t-shirts and I need this many white, shorts, and I need this many black belts. They're going to think about how many NFTs of a particular item they might need. And so if you think about it in that context, now it becomes, how do you make this available to other people? How has this become something that, anybody can purchase, anybody can acquire? And that's why what we're doing at NIFMIT is we're abstracting a lot of that cryptocurrency layer for the average consumer. While I do think it's really interesting for people to hold their own keys and hold their own wallets, I think that's a tremendous value. And I think anybody here should learn how to do that. The fact of the matter is there's always going to be a segment of the population that's going to prefer having their assets custodied by someone else. Hence why we use banks, hence why we use, brokerages, et cetera, because we trust those entities over ourselves in managing those sorts of things. So we think that's going to be the case also when it comes to NFTs. And in fact, that's what we're seeing, right now overall. So I love, yeah. To continue with how to think about NFTs for anybody that's here overall is, if you believe that today there are more digital products available than there were last year, then you probably also believe that next year there will be more digital products than currently. And you probably also believe that that is going to perpetually increase. Digital products will continuously increase. So if that is the case, if I was to ask everybody here on this call, guess what? Thank you so much for attending this conference today. I want to reward you and compensate you, or not even compensate you. I want to reward you and thank you by you this really amazing PNG. A PNG is a really neat file type. You can actually and see, you can put it on your phone, you can put it anywhere. Who wants this PNG? Or I could say, I'm going to give you a file type that showcases the total amount that were created, that showcases your order in which these were created, where you place, that showcases that you are the actual owner of this, and also has a digital representation attached to it. Which one would you prefer out of those two? My guess is that you're going to prefer the latter. And so when we think about how NFTs are created today, we can't think about that is what they're going to be like in the future as well. So some of the concerns that come around when people think about NFTs, particularly around Ethereum, is the fact that, hey, like that has an environmental impact. You have to mine cryptocurrency or mine Ethereum to produce the coins, the tokens that are used to create these NFTs. The first engine was not the most carbon safe, carbon neutral engine. The first computer was about the size of a house. So technology improves over time. So I do believe that Ethereum at some point will figure it out. And, you know, they've been talking for a long time of getting to, basically proof of stake. At some point, they perhaps figure that out. But even if they don't, there are other blockchains that are also figuring out different proof of stake type of mechanisms, or for easier way to explain it, mechanisms that don't produce as much energy to create that blockchain overall. So if the environmental impact goes down, if the cost goes down, which it should and it will, if it creates less energy, et cetera, and again, we can create file types that have security aspects to it, that have the ranking, the order, et cetera, why would you not want to NFT just about anything? So if you come at it from the lens of an NFT is this rare, scarce item, and then you NFT, I don't know, a mug, then you're gonna be like, that's silly. Like, why would I NFT a mug? I don't want it. Why would I ever NFT a mug? That, you know, that's not going to be worth anything in the future. But if you come at it from the angle of, hey, there were 10,000 of these mugs created in the year 2022, and you know, we want to just make sure that we're tracking our proper inventory, and you know, this is a certificate of authentication because this mug comes from, I don't know, some volcanic clay in some far off distant land, right? So again, like that you're creating these elements as to why you would use this overall. So you can't think about this strictly from the lens of rarity, scarcity, because it's going to be a really short-sighted lens for that. The next thing I want to go into with all of this, so is, you know, when it comes to, call it, you know, blockchain or consumer use cases, because that's something that I really like to focus on and think about, is, again, remember that there were people who thought e-commerce wasn't going to work out, right? There are people that thought social was not going to be a thing. There is a really, really big corporation in Seattle, or Redmond, I should say, that didn't think mobile smartphones were going to be a thing, right? And every single one of you has one of them right now. And probably some of you are looking at it right now. Gotcha. Because one of the things I say, and I say this to myself, you know, your lack of understanding of something or someone's lack of understanding of something does not impede its value and doesn't impede its progress. So even if you think that this is something that's far away, I definitely recommend it being something that you start to look into and start to think about, but also think about it from the consumer context lens, because changing consumer behavior is really difficult to do. You know, forcing net new behavior is always going to be very difficult to do. And so that's why, as we, you know, kind of evolve in our consumer habits, is they end up being little by little rapid iterations, you know, of things overall. So, you know, if you told someone right now, you know, 20 years ago that they would use their Nokia brick phone to purchase at the grocery store, they'd be like, "You're what? How am I going to use my Nokia brick phone?" If anybody knows what that is, but it was my first cell phone when I was in high school. You know, you couldn't have done anything with that now, but sure enough, you do it with a cell phone. And is it really a cell phone? It's actually basically a computer, you know, in your pocket. So what I'm really trying to make sure that we understand here is that across all technology, crypto included, is the initial use case doesn't mean it's necessarily the final use case overall. And I think that we've seen that when it came even to how Bitcoin has come into play and was created, to how people think about Ethereum, to how people think about building out dApps, to even things like DeFi, which is decentralized finance, and being able to essentially earn yield on things. These are all things that have been continual evolutions of Bitcoin originally, of course, right? So I hope that's helpful. And yes, you can feel free to reach out to me over LinkedIn. And Sundeep and UW, thanks for having me. I'm a UW alum, so I will always do anything for the University of Washington.
Thanks, Jonathan. It was very insightful. Thank you so much. So our final panelist for today is Joseph Vincent. Joseph Vincent is the principal of Joseph M. Vincent Limited PC in Tacoma, Washington, a financial services regulatory practice and consultancy that includes representing DeFi and other fintech companies. Prior to May 2021, he was Director of Regulatory A Legal Affairs at the Washington Department of Financial Institutions for 18 years. In a professional career spanning 4 decades, he has also undertaken a number of other roles, including housing law consultant, civil litigator, and a trial lawyer, corporate counsel, a loan administrator manager for a Seattle headquartered regional bank, IT entrepreneur, and president of an online mortgage company. Vincent is a past recipient of Seattle University of Law Civil Externship Supervisor of the Year Award and received the 2019 Adjunct Professor of the Year Award. He is a graduate of University of California and Golden Gate University School of Law in San Francisco. So Joseph, the perception is that cryptocurrencies are not very well regulated, and it's just wild, wild west out there. As a lawyer, how are you advising and educating your clients related to the regulatory and compliance requirements when it comes to cryptocurrencies?
That is not a correct statement.
Okay.
This is a very regulated space, almost from the very beginning. But before I launch into that, I just want to do a shout out to my friend Jonathan Blanco. He said, where we start out is not where we end up. And I want to tell a little anecdote. I happen to have had the privilege to sit on a legislative panel that created the first digital signature law that could be used commercially in the United States. This was before the E-Sign Act of 1999. This was before the Uniform Electronic Transactions Act, which was technologically neutral or agnostic. And this was way back in '95. And we created a law that on the books in Washington with the object that we would use a thing called digital signature based upon a concept called paired key encryption and public key infrastructure, which you'd have a public repository and a private key. Okay, this was very innovative at the time, and everybody thought we were going to get adoption, but unfortunately the bigger companies, including Microsoft, et cetera, were interested in authenticating machines and not authenticating people who would actually hold addresses. Okay, fast forward many, many years, and whoever Satoshi Nakamoto is, and a number of us in the area are always speculating, you know, is it Nick Szabo? Is it David Chom? Is it a combination of people, whatever? Fast forward to 2009 with the Bitcoin white paper, and one of the core fundamental aspects of the Bitcoin protocol happens to be the use of PKI-enabled digital signature. So I thought the use of the Washington Electronic Authentication Act was, you know, that the time had passed, that any of the technology there was never going to come to fruition. And then when 2009 rolled around with a Bitcoin white paper, I said, second life. I am pleased to say, so that's just by way of saying, and a shout out to Jonathan, that things have a way of coming around, okay? Things have a way of catching up. I'd like to go through just an overview of what the regulatory process is. So when Bitcoin came out, it claimed to be digital money, okay? And that it could be used as a substitution for fiat currency, where you wouldn't need a central bank. That was essentially the idea. It was essentially a libertarian concept. And so no sooner did that come out than very, very soon after that, government started looking at this. Well, how are we going to tax this? What is a Bitcoin from a legal standpoint? And the IRS zeroed on the concept of it being property. Property in the sense that it's subject to recognition of income upon its sale. Okay, and therefore that's a capital gain, and depending on when you sell it, you either have a short-term capital gain or a long-term capital gain. Well, that raised a whole bunch of issues out there as to whether it could effectively be used, and that's still the approach of the IRS today when we're looking at strict cryptocurrencies. I'll talk about stablecoin in a minute. So the issue behind that was, well, if it's subject to a potential capital gain event every time it is transferred, then can it ever really be effectively used as a widely used medium of exchange? Okay. And indeed, eventually when the cryptocurrency exchanges came into being, where they would hold your crypto for you as a custodian and also transfer it for you, and we'll get to that in a moment. Cryptocurrency exchanges like Coinbase, for instance, the IRS even came out and issued a cease and desist order against them because they were not doing 1099s to their customers. Customers were not putting any of their gains and losses on a Schedule D on their tax return. They weren't doing Reg B reporting to the IRS, et cetera. And all of the cryptocurrency exchanges that are licensed, and they are licensed in the United States, there are offshore ones that aren't, but they won't do business with Americans. You can't, you have to be whitelisted before you can use a cryptocurrency exchange in the United States. So there's a lot of regulation in that area. And it's revolved around basically the premise of what the IRS decided to perceive cryptocurrency itself to be. When I speak of that, I speak of Bitcoin and I speak of Ethereum, those kinds of cryptocurrencies. So the question then still becomes, well, is it money? If you were to ask the current SEC chairman, Gary Gensler, who in most recently speaking to the Aspen Security Forum last August in Jackson Hole, he would say that none of these cryptocurrencies are really money because they don't meet all three elements of what money is. Summer Zaidi quite clearly spoke that it's a medium of exchange. I'm here to say that Mr. Gensler doesn't really see cryptocurrency as such as being a medium of exchange. You have to be a medium of exchange, you have to be a unit of value, and you're a store of value. Now we can say unit of value and store of value for cryptocurrency, but I'm just telling you what the top regulator of the securities industry says, and he says it's not really a widely held medium of exchange in the sense that it's not widely being used as a form of payment for goods and services. So how is cryptocurrency being used? Well, then the question then becomes, well, it's mainly being used, cryptocurrency itself, for speculative purposes, for holding in terms of its value going up or down, and for speculative purposes. So that raises the whole issue. If you're holding it for speculative purposes, is that kind of an investment a security that requires securities registration? Well, very early on, Bitcoin was determined by the Securities and Exchange Commission not to be a security, Bitcoin itself. The same thing holds true for Ethereum. I don't think they really bothered with the heavy duty logic behind that. They just simply say, well, now it's a thoroughly decentralized ecosystem, so we're not going to bother treating it as a security. But we do have a controversy going on right now with Ripple, the symbol being XRP. Currently, the SEC is embroiled in litigation against Ripple because it used its issuance of XRP. It used the money it received from that issuance of XRP actually for the funding of the technology. Okay. So I just want to say, and I can talk about it later because I want to get through the rest of this, but the point is, in every one of these kind of cryptocurrency situations or stablecoin situations, you have to ask the question, does it or does it not meet the Howey test of whether or not it is or is not a security? The Howey test is basically a United States Supreme Court case from long ago. It's the basic test of whether something's a security. An investment in an enterprise in which you do not have an active participation in that enterprise from which you expect some kind of profitable return, okay? And a reasonable expectation of a return, etc. And so that being the test, that's a test that has to be applied in each situation. So as an attorney, I look at a number of different things when I'm representing a client as to whether that's one of the first things I look at. Is this a security or not? Okay, that's one of the first questions I ask, okay? There's all kinds of permutations. Now, something did come along called stablecoin, and that's where you actually peg the coin you issue. By the way, it's minted. That is, it's actually issued. It's minted. It's not mined in the sense that Bitcoin is mined, or in the sense that Ethereum 1.0 is mined. There's a new version of Ethereum that's going through its stages called Ethereum 2.0 that basically is a proof of stake concept. But most cryptocurrencies, the big ones, are proof of work. And so there's an actual mining that takes place. You mine them, and they're not minted. But stablecoin is actually minted, and it's used as kind of a workhorse for developing what we call a payment system. Now, the first iteration of that happens to be what we would call a sovereign fiat currency backed or pegged coin. The first one being Tether, and then several have come after it. There's about 74 of these stable coins, but the fiat-based ones are the most prominent. But there's also other stable coins. There's ones that are pegged to certain commodities, like gold. I happen to have a client that is a stable coin. It's an asset tokenizer as a service company at this stage. I'm seeking a trust company charter for them, but they actually have minted stablecoin backed by for another company, backed by gold held on a one-to-one basis on reserve by the Royal Canadian Mint. Now, the theory behind this stablecoin is that there will be one-to-one reserves in the case of the fiat-backed ones held at a bank. That's a little bit of a problem associated with Tether, because Tether backs some of theirs by what we call commercial paper instead of actual dollars, okay? So we'll get into this in Q&A and roundtable. But then there's other kinds that are very, very interesting in the area of DeFi, and these are what we call crypto-pegged stable coins. And this leads into this whole area of the DeFi area, okay? Now, when you buy Bitcoin and then at an exchange, and then you want to sell it or trade it out for Ethereum, say, what will typically happen is that the exchange, they won't, when you sell your Bitcoin, you're not exchanging that back into fiat and then taking the fiat currency and then buying Ethereum. What they will use is they will use stablecoin inside the crypto ecosystem to make those trades. That's why it's said that stablecoin, fiat currency pegged stablecoin, is the workhorse of the cryptocurrency ecosystem, and therefore it's considered the payment rail in DeFi. So this leads us to the issue of a lot of things that are going on in DeFi. There are an awful lot of things going on right now with respect to DeFi lending. That's where you would vend in digital assets. That could be, you're literally lending your crypto or lending your stable coin into some kind of a DeFi pool with the expectation of a yield, okay? And so this is where we get into decentralized exchanges or DEXs, or we get into decentralized autonomous organizations or DAOs. That's a very, very unusual area right now that is right at the cutting edge of how is that space going to be regulated. Now, when we're talking about stablecoin, particularly fiat currency stablecoin, the president's working group, headed by Treasury Secretary Janet Yellen, puts out a paper in November of 2021, basically saying, well, we think that the only folks that can that ought to be able to issue stablecoin are regulated banks. There's a dissent from that. The dissent from that even included the outgoing vice chair of supervision of the Federal Reserve, a person I respect, Randall Quarles. He thinks that that's unnecessary. There's even as late as February 4th, a House Financial Services Committee hearing in which there was clearly bipartisan support that they really didn't necessarily want to see stablecoin, that it be mandated that a bank do it. So notwithstanding what the administration wants to do respecting how stablecoin is going to get issued and who's going to do that, I don't think there's going to be any movement on that in quite a while. So is there a lot of regulation and eyes on this? Absolutely. Finally, I'd like to say a little bit about money transmission, however. This space is actually regulated quite heavily in the area of money transmission. You do have, if you are a money transmitter, you do have to register with Vincent, okay? If you are going to do money transmission for customers who happen to be in 49 states, Montana excluded, you must get a money transmitter's license. So the question becomes, what is money transmission? Well, money transmission basically is the receiving of funds, and that's been held by most of the states to be virtual currency. It can be, you know, even though it's not classically money, it's the equivalent of money. The receiving of funds for transfer to another location, okay? And so all the cryptocurrency exchanges now that you see, the most common ones, wherever they do business in the United States, they are required to be they are required to be licensed as money transmitters, okay, under money transmission laws, and that also includes other companies. They'll be treated very, very much just like the other money transmitters who actually do currency exchanging and transfer of money, like a Venmo or something like that. They're all regulated like that. Finally, I'd like to say that the question then becomes, who is going to be allowed to custody or to act as a fiduciary for digital assets? Well, if you custody is something, as we know, custody is the power to hold, and being a fiduciary is the power to manage. Okay, in most instances, you're conducting an activity where you hold digital assets for someone based upon strict instructions, and that would only be custody, okay? And so the question then becomes, who can do that? Most entities that try to custody these assets want to be perceived as capable of being an SEC qualified custodian. Now, who can that be? That can be a bank, it can be a broker dealer, or it can be a trust company that must comply with the equivalent of Regulation 9 of the Office of the Comptroller of the Currency rules. Comptroller of the Currency being the federal agency that charters and regulates national banks. But many other regulators look to Reg 9 in that context. So I'm gonna just sum up here by saying there's more that I could discuss in that area, and it may come out during the course of this, but I will tell you that this is a very regulated space. And there are gonna be some winners and losers in this area as well. And I would like to have an opportunity to discuss that with you. And so I will leave it there, and pleasure to be here.
Well, thank you, Joseph. So definitely, based on what you have told us, it appears that it is a very regulated, people might not see it or hear about it, but it is a very regulated environment. Well, thank you again. So, and at this point, we'll take a short 10-minute break, during which the attendees may begin to submit their questions through chat for panel discussion. And we'll be back after 10 minutes. Welcome back, all attendees. Now we will begin our panel discussion. We have received lots of questions for our panelists. Time permitting, we'll try to answer as many as questions as possible. So let me start with the first question for Summer. Summer, we all heard about double entry accounting and double entry system. What is triple entry accounting, and how is this relevant to digital assets area?
That's a good question. I think that the concept of third entry was introduced by a professor at Carnegie Mellon University, I believe, where he had presented a new framework of a complex way of doing accounting. The term third entry introduces the blockchain component, where the blockchain binds the double entries and potentially provides an external auditing view, because it also includes the digital signing. So basically, in current accounting environment, each company has their own books of transactions. With the third entry, the company will be able to share every aspect of the transaction, such as like what the product is, who's the seller, who's the buyer, and all of that information is going to be digitally signed, making it difficult for the transactions to be susceptible to manipulations or financial fraud. So as blockchains are completely automated and decentralized, once an entry is recorded, it can't be edited, altered, or removed. So it kind of adds a little bit of accuracy to the transaction, considering that it's going to be digitally signed. It also would leave no gaps for errors, and at the same time, it'll be verifiable for all. But when we talk about, if we were to talk about whether or not this is something that's going to be replaceable, I mean, triple entry accounting is that's definitely up for debate, but it certainly isn't something that is currently being used in a significant manner. In my opinion, even if regulators and companies could get over the double entry accounting, it seems a little impractical to use a more complex system. And I say that only because it's hard enough to get accounting right when there's only two sides of the entry. Adding another one, I'm just not sure how that's going to work, but that's my opinion. There's always the future. We'll have to see what that holds for us.
Well, thank you, Summer. I appreciate that. John, I have a question for you. From security perspective, we hear all the time that, as Joseph was mentioning earlier too, that yes, hacker got in and took away millions of dollars of cryptocurrency. And recently there was some news about somebody taking $320 million from a cross-bridge chain. So what are we doing from industry perspective to make these blockchains so secure and so that we don't have this risk going on? Obviously, the risk will be there, but what is happening in the marketplace? How are you dealing with these kind of things?
Yeah, so to clarify, the majority of the hacking that takes place is what's called social hacking. So people finding or gaining access to, email, password, seed phrases, and it's typically done through phishing attacks. So what a phishing attack is essentially when you get a unwarranted email sent to you that looks like it's coming from the actual sender, and asks you to take some sort of action. So, things like that can be everything from, hey, enter your seed phrase here in order to recover XYZ, right? You never share your seed phrase with anybody. That is only for you, just like you don't share your passwords with other people as well. And then at the, call it exchange level or some of like these really big, type of situations that happen is, believe it or not, it was similar in that instance, right? As someone had from a social aspect, gained access. No one's actually hacking the blockchain and putting some Trojan horse virus into the blockchain. That's not taking place. What's happening is typically at application layer, there is some level of compromise that has taken place. So a couple things that the average person can do to at least prevent this from happening to them is, if you are going to have large sums of cryptocurrency, you probably shouldn't leave them on an exchange. If you are on some, I call it like the more common ones like Coinbase, and some of the, call it the more consumer friendly ones, they do have, actually, Joseph, you probably know this better than I. Does Coinbase have FDIC on assets? I can't remember. Some of them do, but very few do.
Well, Coinbase itself is not. Coinbase is just a regulated money transmitter.
Yeah, I just couldn't remember if they. I feel like they have some security elements that they offer, but from like a hacking perspective, but I could be wrong.
They do. If you really want to third party to hold you really need a trust company or a bank that's a custodial bank. And they comply with the strictest, examined by the regulators, cybersecurity for purposes of not being able to hack the private keys that are in the cold storage wallets.
Right. And so if you do have your own, if you are going to be managing your own private keys and so forth, you just want to make sure that, you keep those, in a safe space. You're the only person who knows them. Probably shouldn't even save them on your computer. But yeah, the main thing is just don't share information with people that shouldn't have that information.
And remember where you keep him too, because he's now dead, unfortunately. But when he died, the heir to maybe at that time in value, Ripple was trading at such a thing that he had about $2 billion worth of Ripple. He was one of the heirs to the Mellon fortune. And but he didn't let his spouse know where all of his cold storage wallets were. And so when he died abruptly in a hotel room in Cancun, nobody knew at all but him where he had kept his cold storage wallets. $2 billion worth of Ripple. So know where you keep things.
So Paul, from risk advisory perspective, I'm sure your clients are asking the questions about security. So how are you responding to them about this and what they need to do?
I think one of the biggest things that we see, not just in a crypto space, but just the industry in general, is that there are always vulnerability in applications and security. And one of the key things that companies can do to prevent that is to be aggressive in patching. So in the sense that, I'm using a third-party vendor or a third-party SaaS solution, and they release some products, like even, I'm sure everyone on the call gets that notification about, Microsoft needs to, apply these security patches. And I don't know how many times I've ignored them because I'm in the middle of doing something or whatnot. So one is, just making sure that your systems are up to date with their security patches. There are things that occur, like similar to what Jonathan and Joseph had mentioned related to account takeovers through phishing attempts and attacks. Those are really outside of the responsibility of the organization. In a sense, like if you read the fine print and the terms of services for each of these, you might not be aware of what you're being protected against and what you're not being protected against. And then when your funds are gone, that's when it becomes a big surprise. And like, hey, what did you guys do to protect me? And a lot of the language in those terms of services says you use this service as is. Like we guarantee basically nothing. There's no liability on our end. So from losing money on that standpoint, I mean, that's one thing that, we take the advice that Jonathan provided and really just make sure that we're doing things to protect our assets. But from a company standpoint, making sure that your technology is up to date. Don't use things that are end of life, end of service. A lot of the Microsoft products, after a certain amount of years, they cancel their extended services, and then you're kind of left on your own to manage those. And that's when there's a lot of vulnerability. So I would say for our standpoint, really understanding what data you're trying to protect, making sure that you classify that correctly and put the strictest policies possible on that data. And then just overall maintaining the integrity of your system by applying security patches as they come up.
Thank you, Paul.
Yeah, and I was sorry. I was just going to jump in, and I would say that's exactly what those controls are that I was talking about from an audit perspective, that when we go in and look at them, those are that controls that we're looking at from the business perspective. What are some of the things that the business and the company is doing to make sure that there is no susceptibility of error or fraud that can occur on any of the assets that they have on their books? What's the risk that something can flow through and they lose it, it's not in their hands anymore, or it's not accurately reflected because it has been lost, or they don't have the keys anymore, and so on and so forth. So that's just like the full circle of accounting from just the risks side and then the auditing as well.
Well, thanks, Summer. Joseph, you mentioned stablecoin as a stable kind of cryptocurrency, yet because it's pegged to fiat currency or commodities, aren't they just that fiat currency under a different name? And what kind of a benefit does this actually, what I was going to ask you is that, what kind of benefit does this actually provide a user over a normal fiat?
Okay, well, most fiat today is digital. I mean, you're not sending paper currency,
right,
in the payment system. You're using you're either using the card ecosystems, the major cards, of course, being Visa, MasterCard, or Discovery or Amex, or you're using automated clearinghouse or ACH. Card ecosystems are covered by the rules of the card associations, actually, in that ecosystem. On the level of automated clearinghouse, they're controlled by the National Automated Clearinghouse Association, or the NACHA rules, which is about yay thick, and all the members abide by them, et cetera. And those include banks, but they also include merchant service processors who do the heavy lifting for acquiring banks and indirectly for issuing banks of those cards. And you don't even know these folks exist. Okay, they're just a whole hundreds and hundreds of payments processors. So literally, in the case of stablecoin, it's another payment rail. Okay, it's the opportunity to use a much cheaper way of delivering funds instantaneously that is not going through a payment system, including not going through SWIFT. We've all heard about SWIFT in the last few days, if you don't think about SWIFT before, in terms of the ban on Russia from being part of SWIFT. So that's how it's used. And what it is stablecoin is, in the case of the fiat-backed ones, is pegged to a fiat sovereign currency. In this case, we'll say the US dollar. It's pegged on a one-to-one basis. So when you stake and mint a stable coin, there has to be an equal amount of reserves held in a correspondent bank relationship that you have. Now, most of these are held in banks. One of the big ones that performs this service is Silvergate Bank of La Jolla. Another one is Signature Bank in New York. But there are, I mean, Mellon Bank is in on this, largest custodial bank in the world. Several London banks are involved in this, etc. So in any way, there are, and JP Morgan Chase is involved, believe me. So it's because they even have their own issued stablecoin. So it's another payment rail to use this technology to create instantaneous transfer of funds. And it really works as a workhorse, basically, when you're trading in and out of different positions in true cryptocurrency, okay? When you redeem the stable coin, in other words, you basically want to get rid of the stable coin, and you redeem it, the coin is burned. In other words, it goes away, okay? So the key issues in staking, redemption, burn, okay? So that's essentially in a nutshell what's going on there. And it's quite widely used in DeFi.
Joseph, I have a question for you. You're a professor and you teach law students about digital assets.
Yes.
Can you discuss the areas you think that about crypto we should be including in our academic curriculum for accountants?
Yes. One of the things I wanted to mention first, but I get out of the way, is I feel very, very privileged to be on the same panel with auditors, because I miss that, because I worked with auditors in a sense, both directly and indirectly for 18 years at the Department of Financial Institutions, because the banking examiners that I work with are essentially performing an auditing function. The outside accounting firms that have to represent all the banks that the agency I was at regulated, we dealt with them on a regular basis. So it's a real privilege, and I respect that. One thing that I think where triple accounting entry might be useful, and I wouldn't want to use a public blockchain for it. Certainly you might want to use it in the context of a private permissioned blockchain, because you can have those too, okay? Is that third rail, that third entry could be used in such a way that it could support the concept of regtech or subtech. Now, regtech is where you use literally fintech tools so that other part of the enterprise that's over there called enterprise risk management could take a look at that separately. On the other hand, if you want to deal with your regulator and you want them to be able to see something that maybe you might be able to use that third entry. I haven't looked at it, but you might be able to use it in what's called subtech. That's where you use, you work with a regulator to literally use fintech tools so that they can examine and regulate you better, okay? And there's great promise in the area of regtech and subtech, so I just sort of wanted to get that out of the way. But could you repeat your question again? But I wanted to say that, I apologize.
Yeah, so what are the key areas you think accountants should be learning about?
I really think that what accountants should be learning is the following. There should be some basics in an elective dealing with the legal aspects of this, because they're actually not that hard to understand. Mm-hmm. I tried to do that, but it actually takes just a little bit longer to give the highlight, but to walk through the history of how we've gotten to this space so that we can then look at what we're looking at now. As Jonathan said, we're moving to this area of Web 3.0. I'm sure Paul and Summer can speak to this as well, where that people are literally going out and creating these vehicles for investment that look a lot like money market mutual funds, mm-hmm. or they look a lot like deposit taking. Every accounting student knows that deposit taking with a banking it's an arm's length transaction, but the depositor is really lending the money to the bank. with the promise that they have a claim on it when they want to make demand on it. That's why we call checking accounts demand deposit accounts. Okay. On the other token, back when we created the money market mutual fund industry way back in the late 70s, early 80s, and then everybody took their money out of S&Ls and put it into the market, we made the decision not to regulate those like banks. Mm-hmm. We made a calculated decision to treat those like we would do regulation light. We would call them, we would treat those vehicles like an investment company under the Investment Company Act of 1940, which is how, and that basically, and so that's what a lot of these liquidity pools or staking pools look like. And so there's a big push me pull you for how that's going to get regulated. I think it's very, very, very important that some of those basics be looked at. And since there is a really, really good set of business law courses for accounting majors, there has to be. I think adding that as an elective would be very useful.
Well, thank you, Joseph.
Hey, Sundeep, I would like to add on to that as well. I know we looked at it from a legal standpoint with Joseph, but I think Summer and myself have both raised that controls are very important within any environment. Risks and controls go together. And what I see oftentimes when I work with financial auditors is that they very, very much dislike controls and kind of treat it as a secondary to their substantive procedures, which is the actual ticking and tying of numbers. But there is just so much importance in controls. At least when I was in school, like we had maybe one course on controls and that was it. Everything else was focused more on accounting and finance. But I would say like the controls and the risks, like if you can understand those concepts, then you can work in any company, any business, everywhere, because at the end of the day, those controls are there to mitigate a risk. And if those risks aren't mitigated, you not only run into issues with your ICFR, internal controls or financial reporting opinion, but that also has impact on standard procedures as well and the reliability of that. So I myself, do a lot of controls and risks, like those two kind of go hand in hand with all of my clients. I think that is just an area that I feel that, at least for the folks that I talk to straight out of school, they just don't have a passion for that. And that's such an important part in accounting.
That's music to my ears. Thank you.
Thanks, Paul. So as we are approaching our wrap-up time, I have a open question for all the panelists. Any closing remarks, comments, advice you have about the future of cryptocurrency? I know we could talk for hours on this, but would like to hear your thoughts.
I don't mind going first. I mean, I think that we're seeing, more and more information available to what a digital asset is, what a cryptocurrency does, what a stablecoin does. And I think the more that consumers are using it, the more that it's going to become part of Main Street, right? Like you can do so many things. There's wallets that you can have now that you can choose to pay with crypto at any of the different stores that you go to, if they accept Apple Pay and things of that nature, or if you have a Venmo account, that's an option that you can do. I would say that this is just really the beginning. I think we've heard from Jonathan related to NFTs, Joseph with from a legal and regulatory standpoint. There's a focus on this for a reason. And I think that, if you really want to solidify yourself as a professional, right? These are the type of things, the new things are the things that you can provide the most value for. Legacy standard procedures. I mean, yes, you can be an expert, like, a tech example, like mainframes. Banks use mainframes, but they're such an archaic technology that there's no future in it. But if you think about kind of all the different things that are evolving within the ecosystem, specifically in our payment realm, that is a way to distinguish yourself from everyone else. I know there's people that are, all trying to do the cool thing, but become an expert, right? Do the research. CoinDesk has a lot of good information. The internet is such a powerful place for you to learn things. I mean, half of the stuff that I learn is on the job. The other half is through Google searches. So don't be afraid to use that, but don't use it as your only means of knowledge. do some additional research, read text, read white papers. I think that's the big thing. But I do see, digital assets is not just a fad. It's kind of the next step. Like I think Jonathan had mentioned this, like Internet 3.0, right? It's what we're going to be seeing and using in the future until some other technology comes and disrupts it. But at this point, we're not at that stage. So, capitalize on this. The market is hot. So I would say for the students that are out there, really thinking about what should I do for my future, it's not a bad place to be. So that would be my closing thoughts. And it's really cool that the School of Business at UW actually has something like this. When I was in classes, way back when, I think the only thing that I learned about like the hot topic was like SAP. And now SAP is just like, who cares about SAP, right? So it's like one of those things that things are shifting, but excellent job by the ASA to really make sure that we're bringing top of mind topics to the students.
I totally agree, and I would echo the same sentiments. I think digital asset ecosystem is something that's very unique. It's up and coming. It's a hot topic, but it just doesn't stop at cryptocurrency. There's exchanges. There's derivatives. There's DeFi. There's NFT minting. There's NFT being purchased. There's miners. There's just so much in the ecosystem right now. And I know as we go further and further down the road, there's just going to be additions to the different segments, and there are just going to be so many more branches. So I would echo the same thing: become a subject matter expert, learn through YouTube. There's so many videos. There's CoinMarketCap. There's CoinDesk. There's so many different videos and informational and educational sessions that are being held on Bitcoin and Ethereum and blockchain in itself. Try to pick that up and get involved as much as you can. And of course, if you're investing in something, just make sure you consider the risks that are involved so that you don't end up becoming, a victim of all the scams that are going on at the same time. So, I mean, just know what's coming up. This is something that is going to be a common industry going forward. I don't think it's going to be a fad. It's something that's definitely going to grow in the next few years as we get more and more information, a lot more third-party service organization reports that are now going to be developed over the business controls, over the automated controls on the different exchanges, services that are being provided. So this is definitely something that's going to be a big industry to be involved in the next few years. And I would recommend the same as get on it and learn as much as you can and become an expert before you even get into it and get involved.
Jonathan?
Yeah, I always love this question. Like, what's the future of Web3? And honestly, the future of Web3 is right now. So if you were to ask this question a year ago, 2 years ago, you'd be like, oh, we're going to be at this phase where we start incorporating, more crypto payments, or we start, having more utility among assets. And we're at that moment right now. The thing is, though, it's only a small, tiny fraction of individuals who operate in that ecosystem, but that ecosystem is growing. When I had a company in 2017 and we were talking to brands about cryptocurrency and about loyalty points using cryptocurrency and so forth, they had no idea what we were talking about, nor did they care. And now we have brands that cold inbound us, like they are so interested in moving forward with crypto and Web3 and NFTs that they literally just send a blind email to our info saying, hey, can you help us with this? So that's going to continuously move and evolve and change. Imagine if you got to, join into an e-commerce company when e-commerce was first starting up, or imagine if you got to join into a social company when social was first starting up. We're still at that phase, I think, in crypto, where regardless of what happens here, you're going to be learning things that really stretch your thinking. And the fact that you get to be at the kind of at that early phase when, call it, the next evolution comes up X amount of years from now, you'll also be able to see that a little bit different, a little bit clearer, a little bit faster. Last thing I'll say is that a lot of people say this, but I also believe it to be true. The smartest people in the world are working on Web3. And so it's definitely a good place to be and work with other folks.
Thank you, Jonathan. Joseph, your thoughts?
Yes, well, I just learned a lot from some of the fellow participants today, and I really appreciate that. I would just like to focus on one thing. We have such a great opportunity. I could reiterate what some of the other folks said, but we have such a great opportunity with Web 3.0. Don't stifle this. I'll tell you one reason why. Currently, there's a movement right now that would actually make central bank digital currencies exclusive. So, in other words, you could not basically have some of the things we're doing. And that literally, they're talking about doing this to rebalance the Federal Reserve's balance sheet. They will bring people onto the balance sheet. So consumers would be brought onto the balance sheet, okay, of the Federal Reserve, literally. And you can imagine the loss of privacy associated with that kind of a central bank digital currency. At the very least, we should do something that would involve using bank intermediated stablecoin, that's fiat-backed stablecoin. But I don't even think that that's called for, because I think that this raises, why would we use old Glass-Steagall approaches to separation of banking and investment banking, et cetera, when that isn't even being used for regulated banks? Why would we do that? And essentially, that's what's going on right now. So you have one group over here who would literally want to stifle the innovation in this technology. And then you have another group who doesn't. Now, does this space need to be regulated? Absolutely. But you really, we have to make sure that more of us get educated on this area. We have to make sure that our politicians get educated, et cetera. There are a lot of unintended consequences associated on how we play with the payment systems in this world. And I think we need to think long and hard about that. I think we have some wonderful things happening organically within this this whole technological firmament that we call Web 3.0. I think that on a case-by-case basis, federal regulators need to look at it functionally. I think we need functional regulation to protect the public, but I don't think we should throw the baby out with the bathwater. And so I'm here to say that there are some forces that would stifle this and try to create a command and control society, much like the digital yuan in China. This is something we cannot have if we're going to have free and open markets. And so I will end there and not reiterate what anybody else had to say. It was just a privilege to get an opportunity to speak before the student body here. So thank you very much.
Well, thank you, Joseph. I was going to ask you that countries like China are completely banning this. And,
they're banning cryptocurrency because they don't want people to buy it to take the money out of the country.
Right.
Okay.
Right.
However, I've created a central bank digital currency that's really like a government-controlled stablecoin.
Right.
And they're using that through their Belt and Road system, and they're also using it internally within China to advance their social credit system of basically controlling their populace and denying them freedom. We really can't have that.
Any specific resources you would suggest for our accounting students to go to read about the regulatory environment around cryptocurrencies quickly?
Several. I'll tell you what I'll do. I will give you a little short bibliography, and I would ask you to send it out to everybody who was a participant today. And I'll do that reflectively and these are all easy to read documents. It's not going to get that wonky. You don't have to be a lawyer to read them, et cetera. And I will do that. I'll put that together in the next couple of days. I'll send it to you. And if you can send this out to the entire listserv of participants, I think they'll find that helpful. Okay.
Well, thank you, Joseph. Thank you so much. So we are almost at the bottom of the hour. So I would like to thank our panelists and attendees for joining the event. A special thanks to the Accounting Student Association for their efforts to plan and provide this event. They have done a wonderful job here in selecting the topic and selecting the panelists. I mean, we couldn't have asked for anything better than that. Well, thanks again, and have a great weekend.